Hi, I'm Victor Cuevas with Victor for Advice. And in this video, I want to try to give you a short and concise definition of what an infinite banking concept policy really is and how it works, so you can get a good fundamental understanding of it. And so to begin with, infinite banking policy is a financial strategy that's built upon the chassis of a whole life insurance policy. Now, when I talk about the whole life insurance policy, I'm not referring to the whole life policy you would get from your local neighborhood State Farm or Allstate guy. Those aren't the kind of policies you want to get involved with. Okay, it's not about death benefit. When we're talking about infinite banking, it's not about death benefit. If you just want a pure death benefit and don't want to save for the future or use your money in a wise and prudent way, then just get yourself a term policy and be done with it. But that's not what we're talking about here. We're talking about a viable financial strategy that you can employ in your life that can be a very sound foundation for your financial future. So, when I talk about the type of whole life policy we're using with infinite banking, we're talking about a whole life policy taken out with a mutual life insurance company and utilizing paid up additions riders. Now, a mutual life insurance company is a company that is owned by the policy holders. It's not a publicly traded company, so the majority of the profit isn't going to the stockholders. A mutual company is owned by the policy holders. So the policy holders are the ones that receive that profit in the form of dividends. So it has to be a mutual life insurance company, and paid up additions riders are very important, because when we design these policies, the majority of the money you put into it goes into the paid up additions, not into the life insurance part of it or the base part of the insurance that pays for your death benefit. Most of the money is going into paid up riders. That when that money goes into the paid up addition rider, it buys a certain amount of life insurance. And at that point, that life insurance is paid up. And so going forward, there's no cost coming out of that. Consequently, the cash buildup can be very, very nice in it. So it's got to include a paid up additions rider, and it has to be designed so most of the money that you put into it goes into the paid up additions. You see how much different that is than going down to your local State Farm guy, whoever, and buying a whole life policy where all your money is going towards death benefit and very little is going to end up in the cash value in the first few years. Whereas with infinite banking policy, the majority of your money is going straight into cash value. So in the first year, you have a good amount of cash value built up that you then have access to do other financial strategies with. So that is the big difference between the two types of whole life insurance. Now, why would you even want to look at an infinite banking policy? Well, the reason it's called infinite banking is because there's all kinds of different financial strategies you can employ using it. You just leave it up to your imagination, and I'm not going to get into all the ins and outs of infinite banking. There's books for that I can recommend, and those are several videos involved in that. But let's go into really the main reasons why you would even want to look at this as a financial strategy in your life. First of all, if you're not a saver, if it's not in you to save money, turn the video off. You don't need to listen to anymore. The problem with Americans, especially middle class Americans, they don't want to save any money. And the interesting thing here is that you go to work and your employer says, get into the 401k. So, okay, that's what, I guess that's what I'm supposed to do for my future. I'm going to put money in a 401k. So you put 3%, 4%, 5%. That could mean $100, $200, $500, $600, $800 a month going into a 401k. Meanwhile, back at home, what are you doing? You're not putting money into savings. You're spending everything that comes in. You're buying cars, you're buying a house, you're going on vacations, you're going out, you're living life, you're living large, you're having a great time. And then you get downsized, or you lose your job, or you get on disability, and guess what? You maybe only have $1,000 in savings, and now you're going to really run those credit cards up, or you're going to go get a loan from your 401k to hold you over for a while. You see, that's backwards. You need, before you even put any money in a 401k, you need to save a certain amount of money for a rainy day. I'd say at least $5,000 for the average family. If you're a couple that earns six figures, you ought to have $25,000 sitting there. I mean, if you're making $150,000 a year as a couple, it shouldn't take long to save $25,000. I mean, how long, that can hold you over for a little bit if things go wrong. At least $10,000 or $15,000. But you're not doing that. People are putting 10% into their 401k and they have maybe $3,000 or $4,000 or $5,000 in their savings account. Not a good idea. So we need to save. Well, where are you going to put your savings? That's the problem. So you put it in the bank, which some of it should be, you're not going to earn anything on that money. So once you get to a certain amount of money in savings, you need to start saving into another vehicle. Again, not in your 401k, but in another vehicle that's going to grow that money conservatively, safely, where you can't be lost. It's guaranteed to grow. And let that grow for you. You put some of your own money, but it's earning better money than it's sitting at the bank. So now your savings is growing on its own, in addition to you putting money into it. Then when you get to a certain point, then you can start saving for retirement. That's the way it should be done. Otherwise, what most people do is they have all their money in the 401k. They lose their job. Things go badly for them. And they have that old 401k sitting there, and guess what they do? Well, there's $40,000 in my 401k. They cash out the 401k, they get hit with a 10% penalty, they pay taxes on the whole ball of wax, they lose a bunch of money out of there, and now they've got some cash to hold them over. You see, what good was it to ever put money in that 401k when you didn't have anything in savings? I hope you understand this principle. If you're out there watching this video and you're putting money into your 401k and you don't have anything in savings, you got it backwards. So now we look at ways we can save money for the future. Now, a lot of people will say out there in the financial world, the Dave Ramsey's of the world and the Prime America guys, buy term, invest the difference. Right? Kind of sounds good to begin with, right? Problem is, people don't save the difference. They don't. And if they do, they're putting it in mutual funds, which is the Prime America guys are going to want you to move into mutual funds. And then your money's at risk. You don't want your rainy day money in the mutual funds, folks. No, I mean, if you had $50,000 and you wanted to put $10,000 or $15,000 in mutual funds, I guess you can do that. But that's not what's being shown out there. Okay, so that's the fallacy. You're not going to end up saving the difference. So we have a financial vehicle where you can save your money. And because it's in a life insurance policy, and it's growing dependably where you can't lose it, it's a discipline. And you discipline yourself better to actually save the money than buying term and putting it in a mutual fund that if you die, your family is just left whatever is in a mutual fund. So let's see how we're going to use an infinite banking whole life policy to save for the future. Well, we've already established that you need to save money even before you put money in a 401k. So where are you going to put that money? Well, to begin with, you're going to put it in a savings account. You need to put it somewhere, and I'm going to call that your warehouse of wealth. Now, let's just say that you've got a couple of thousand, $3,000 or $4,000 in a savings account in the bank. Okay. Now let's start continuing to save money for a rainy day, but let's put it somewhere where it's going to go to work for you. That's where the infinite banking comes in. And so the idea is, where am I going to warehouse my wealth other than in the stock market? Somewhere where I can get to it anytime I need to, and it's going to get me out of a financial jam if I need it, without having to tap into my retirement savings. This is very, very important. So your warehouse of wealth can be your infinite banking policy. So you put whatever amount that you were putting into your savings account, 300, 400, 500, 600, 800, whatever a month, you can put it, and you just start putting it in there. Something you can sustain for the future. It might only be $300 a month or $200 a month. That's fine. That's a good place to start. Just start putting it in there. You will see that over the next 3 or 4 years, you'll have a lot more cash value in there than you thought possible. So your infinite banking can be a place where you can warehouse a lot of wealth. Very wealthy people will harbor millions sometimes in cash value policies. Why? It grows very well for them. That's number one. Number two, there's no taxation. And number three, in the future, they can pull that money out for retirement tax-free. So it's a great place to warehouse your wealth. But it makes a great rainy day fund, right? So let's suppose you have some money in your savings account at the bank, and it's whatever, $3,000 or $4,000, and you're sitting on another $10,000 in your infinite banking policy. Well, now you're starting to develop a pretty good rainy day fund, and you just keep at it. Now, folks, you need to be somewhat responsible with your money, with the way you spend your money. But look, just keep putting money into that warehouse of wealth, your insurance policy, your infinite banking policy, and watch what happens over the next few years. Before you know it, you'll have 15, 20, 30,000, 10 years down the road, depending on if you've gotten pay raises, you want to put more into there. You may be sitting on 6 figures in that policy 15 years down the road. That's going to cover anything that might come your way. So you have your warehouse of wealth, you have your rainy day fund. Another important thing that you can do with this is that you can do banking with it. Now, many people unfortunately want to use their 401ks as a bank. Not a good idea. If you loan against your 401k, they're going to move that money out of the market, put it into something safe, the part that you've borrowed, and now you have that amount of money not in the market anymore. It's not earning anything. Secondly, if you happen to lose your job, that note comes due. They'll take it right out of that 401k. That's penalties and income. So, I mean, you won't get it. They'll use to pay the loan, but it'll still be a 10% penalty and shown as income to you because it'll show as a distribution. So borrowing from your 401k is not the best thing to do. Now, so what if you're sitting on $25,000 in your 401k and your infinite banking policy? Well, it's a warehouse of wealth. It's your rainy day fund, but now you can borrow against it. You know you can rehab a house with just $5,000 or $6,000. Just put a little bit of a down payment on there. You can buy a junk property for 50 grand, fix it up for 25,000, flip it for 110. You've made a great profit. Well, all you need for your first deal is to get 5,000 bucks, 6,000 bucks, and then need a little operating capital. You'll get a hard money loan to buy the house and to fix it. You'll pay interest only till you sell the house. So you might have wrapped up a whole, $10,000 in a house that you might be able to sell and come out with 25,000 bucks in your pocket. You can do that because you have money here. Or you want to buy a car. You can borrow out of there. Pay it back. Good thing about borrowing from here is that something really happens. Let me give you next. Let's suppose someone's got $50,000 and they borrow a $30,000 car. Okay? Now they got a $30,000 note they're paying back, and then they lose their job. Well, I can't make the note on this. Don't have to pay the note for a while. For one thing, when you borrow from here and pay the car cash, you have the ownership, right? Certificate. You own the car outright. You're paying back yourself because you borrowed from yourself. You want to be an honest banker. You want to always pay yourself back, right? However, if you get into a financial bind and you have to skip 3 or 4 months, no problem. When you get ready, start paying it back again. Get a lot of flexibility. You get your life back. You know how liberating, how stress-free you can live your life when you're sitting on an infinite banking policy as your warehouse of wealth, and you can borrow from it on your terms, pay it back on your terms. Pretty good stuff. You can't do that with other things. So, you're banking. Now, how about college? Now, I know a lot of people are doing these 529 plans. I'm not going to say they're bad, but there are several drawbacks from 529 plans. I believe that an infinite banking policy is far superior than the 529 plan. And if you have children that are 2 or 3 or 4 years old, you can start putting money into the same money you put in the 529 plan, put into this. Then when it's time to college, there'll be a good amount of cash value in there, and you can borrow against it or draw it out however way you want to do it. I'd borrow from it, let the cash value continue to grow. Remember, when you borrow money from an infinite banking policy, it's not like from a 401k. They don't take your money out and put it someplace where it's not earning anything. It stays in there cranking out 5.5% in your policy, and they just borrow money from their general lend money from your general fund, and you can pay it back. Pay back interest only, pay back principal and interest. You could even have your child pay your policy back after they've graduated and started making money and say, now you got to pay me back for that loan. You do it any way you want. So for college, funding, excellent vehicle. And here's another thing. Statistics are low, but what happens if you're a parent and you own an infinite banking policy and you're putting money in it hoping that you're going to use it for college for your children one day and you pass on? Well, if it was in a 529 plan, guess what? whatever's left in that plan is all it's going to be, with maybe some growth, you're not going to be contributing it to anymore. But with this, since we do have a death benefit attached to it, I'm going to explain that in a minute, guess what? College, the money is there for your child to go to college. Whether you live or die, the money is going to be there. This is one of the very best ways to fund college, is using an infinite banking policy. Well, what else can we use this thing for? Well, how about retirement? Now, I know there's some pundits out there who say whole life insurance is a horrible place to put retirement money into. Nothing could be further from the truth. Again, if you're talking about your run-of-the-mill whole life policy, you get down the street with State Farm, yes, bad place. But an infinite banking policy, one that's structured specifically to crank out cash, great place for your retirement money. Doesn't have to all be there, but a good portion can be right there, because it will pay out to you in retirement tax-free. And believe me, that can be huge, because we have no idea what taxes will be in the future. So when you're putting all your money in a 401k and you're getting a tax break now when taxes are fairly low, you think you're getting a break. No way. A Roth 401k is far better than a traditional 401k, because one day when you get into retirement and you've been putting money in a 401k for 30 years, all that money is taxable now. And you're going to lose 30% easy during your lifetime on all that money you've put in there. You're going to pay in taxes in retirement many, 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 many times more in taxes than you saved while you were contributing to it. So believe me, folks, getting a tax break, putting money in a qualified plan like a 401k, or for retirement, for business people, a simplified employee plan, that's not an advantage. You will pay so much more in taxes in the future. With infinite banking, you put after-tax money into it, but it's all tax-free in the future. And again, let's suppose you've been putting money into your warehouse of wealth, infinite banking policy, for 30 years, and then you pass on. And you hit 60 and you pass on. Guess what? By that time, that death benefit is way up, because the way we design them, the death benefit goes up every single year. And you leave your family well off. Can't do that with a traditional retirement plan. You'll put money in the retirement plan, 401k, and you get to age 60, the stock market tanks like it did in 2008, and you lose 40% of you're ready to retire. This money in an infinite banking policy will never go down. Never go down. And can pay you an income for life. So for those of you who have heard life insurance, bad place to put retirement money, it's 100% wrong. It is a great place to put some of your retirement money. And if you get with me and I design one for you, you'll see. We'll show you the numbers. Okay, so we've got retirement. And of course, last but not least, of the many things you can do, it is a life insurance policy, isn't it? Oh, I forgot to mention that almost, right? The death benefit. Why did I put it for last? Because folks, when I work with somebody for an infinite banking policy, the last thing I'm thinking about is a death benefit. Yes, when we do a financial workup and go over the estate, if you have no life insurance whatsoever, which unfortunately 40% or more Americans don't even have life insurance. It's ridiculous, but that's what it is. Then yeah, we're going to have to talk about how much death benefit you need. And we can just attach a term rider to this thing. Doesn't affect the cost of insurance very much, and we can put a term rider for 20 or 30 years to get you up to the death benefit you need to be, and still accumulate a lot of cash value. Hey, we don't create the policy for cash value. We'll just put a term rider on it. Sort of like you going out and buying a separate term policy. We can just put a rider onto this thing. Boost up that insurance, that death benefit. But here's the thing. With all the other types of retirement planning and putting money away and things like this, when you die, that comes to an end. You're not putting any more money into it. So if you're a couple where both of you are working and one of you dies, there's a lot of income is gone, a lot of money being contributed to retirement in the future is gone. You're never going to get that back now. But when we design an infinite banking policy, folks, we have to attach a death benefit. It is a life insurance policy. We have to be careful because, believe it or not, if we put in too much money in relation to the death benefit, then the IRA will look at your life insurance policy as an IRA. Did you know that? And tax the money when you draw it out. We don't want to do that. I mean, you could turn your life insurance policy into an IRA type instrument. We don't want to do that. We want tax-free money. So we design it carefully, put in as much money as possible we can, and maintain a tax-free death benefit. Here's what happens. You get 30, 40 years, you've been putting money into this thing. You might be 70 years old. You might be 65 years old. You've just started drawing income out of this thing, and then you die. There might be $500, $600, $800, $1 million of death benefit pays out to your family. Guess what? Their retirement and future is secure. You'll get back in death benefit way more than you put in. So, it's a self-fulfilling retirement plan if you die, or a self-fulfilling college if you die. So, those are some of the just some of the main features of using an infinite banking policy. It makes all the sense in the world. Now, we have a college football coach, Harbaugh, Mike Harbaugh, and I can't remember what college. I think it's Michigan State or University of Michigan, something like that. One of the highest paid, I don't know, maybe Nick Saban is paid more, but he's paid a ton of money. And I think it was last year he got a pay raise, and it was $2 million a year. You know what he did with that? He says, I'll take the pay raise. It's part of his contract, but I want it in the cash value policy. Now, I can't tell you how it was designed at all, but what I'll tell you is this. He's not stupid. He's putting $2 million a year. He's warehousing $2 million a year into a cash value life insurance policy. Why? Well, let's suppose he's a coach for the next 10 years. That's $20 million going into life insurance. All tax-free money. That thing is going to create all kinds of cash value. And what happens if he dies? His family is going to get millions of dollars in tax-free death benefit. Take care of them for the rest of their lives. What happens more likely if he lives a nice long life? I don't know what is. I mean, it'd be hard for even me to predict if he spends another 10 years or 15 years as a coach putting $2 million in it. He might retire with $1 million a year tax-free, $500,000 a year tax-free. I have no idea, but it's going to be a lot of money, and it's all going to be tax-free on top of everything else he's got going. I'm sure he's got businesses and other things. These guys aren't dumb. They're making a ton of money. They do what wealthy people do. They invested in businesses and everything. But guess what? Out of his $9 or $10 million salary, he's putting $2 million in a life insurance policy. He's not stupid. He knows exactly why he's doing it. And these are some of the reasons right here, folks. So don't believe the naysayers out there. Find out for yourself. And this is something you should do. In fact, I recommend you get this book right here, Becoming Your Own Banker. It's by Nelson Nash. He's the one that really made infinite banking what it is today. I went to his Infinite Banking Institute and graduated, so I've been through some intensive training in this concept, and I can help you design something that's going to work great for you. We'll see if it's suitable for you. And I'll close with this. You might have money sitting on the sideline someplace. Maybe you have a brokerage account with, I don't know, $30,000 or $40,000. Maybe you inherited some money. Maybe you just sold some property and you're sitting on whatever, $50,000, $20,000, $100,000 cash. And you're thinking, what can I do with it? Well, there's a lot of different things you can do. I mean, I can show you lots of places to safely invest your money and put it to work where it's going to earn you a great interest rate, but a good portion of that should go right into here. Create your own personal bank. Secure your family's future. Have a place where you can warehouse your wealth, and as you get more and more wealth, where you can put a lot of it. A place where you can borrow money and use it for banking functions. All of these things right here. And a place where you can get tax-free retirement someday. You might have left your job and you have, an old pension plan that doesn't have a whole lot. You can move that in there. Some people have sitting on an old 401k that they moved into an IRA and it's $100,000. What you could do is take a distribution, we call it a 72T distribution, and it will work out a formula, and you might be able to draw $5,500 a year until you hit 59. No penalty. You'll get taxed on the $5,500, but you can take that money and you can fund it into an infinite banking policy. Turn that money into tax-free income one day. So there's a lot of different ways we can fund this, or you can just start by putting $200, $300, or $400 a month into it. It's okay. So I hope this video has been helpful. I didn't get into tons of detail, but I just wanted you to understand the basics and how this can be so beneficial to you. So my name is Victor Cuevas. I'm Victor for Advice, and I'm here to help you any way I can. God bless.